Yeah, I'm Greg Warren. I've been with Morningstar 14 and a half years now. I've been covering Berkshire for about a decade, also been covering the US-based and the Canadian asset managers. A lot of people, when they hear the Morningstar name, don't realize that we actually cover stocks. We've been doing stock research since the mid-90s. Really big beneficiaries of the Spitzer settlement during the early 2000s. We were able to build out a more expansive research group. At this point right now, we got about 65 analysts covering stocks in the US, 20 here in Europe, and another 20 in the Asia Pacific region. So, decent amount of coverage at this point. We tend to focus on higher quality names, companies that we consider to have economic moats. It's a term that we stole from Warren, and he hasn't held it against us yet. But overall, we look at companies that have sustainable competitive advantages and try to forecast out what their cash flows are going to be over an extended period of time. It's very, down in the dirt sort of research work, really fundamental. But I think the best part about what I do is it's independent. I can pretty much say what I want about, any company within reason. And I think that really helps. And I think as far as the Berkshire panel goes, last year was my 6th year of being on the panel. And I was really excited the first year when they asked me to join. It was, that year that we're trying to find another bear on Berkshire after Doug Cass offended a lot of shareholders. And basically, they reached out to me like 5 weeks before the meeting started and asked if I'd be willing to do it because they couldn't find a bear. And I kind of looked at it as, if I'm going to do this, I want to sort of be able to carve out a notch for independent research because for those of you who are familiar or not, every year Jonathan Brandt from Sequoia comes. He's sort of a buy-side analyst. You've got the sell-side analyst where they rotate through insurance analysts, and then I'm on the panel as well. And so far, I feel like I've been doing a good enough job because they keep asking me back every year. When we think about Berkshire, I mean, the interesting thing about the meeting overall is, in the past when it wasn't live cast on Yahoo, I would walk away from the meeting and do a write-up and say, look, this is what happened at the meeting, this is what was said, these are the highlights, but once the meeting started being live cast, I'm like, well, I can't do that because everybody sort of already knows. So I started focusing more on what did I learn from the meeting? What insights did I gain that helped me think about the company, helped me think about research? And generally within the first 2 weeks after the meeting, I'll come out with a piece that talks about what I pulled away from the meeting and how it improved or enhanced our valuation or our assessment of the company. This year was a little bit different. I mean, it wasn't that there wasn't a spirited debate and there was a lot of questions. It was just that I came away from the meeting and I was kind of like, I feel like it's sort of the same thing again and again, and I'm not really, coming up with a unique way to kind of look at, how this meeting went this year. And it took me a while, and I started thinking about, well, what would I say to somebody who was new to the name? Or somebody who hadn't been at the name for a while and was interested in Berkshire, and give them at least 5 good reasons to start thinking about buying the company. And that's really sort of the nexus of the report that we ended up writing and putting out in August, but really sort of talking about the 5 sort of key highlights of the business that I think investors really need to look at, especially now where we are in the cycle. But before I do that, I think it's important, I'm not sure if you can read all of this in the back of the room, but I think it's really important to sort of look at what some of the naysayers are saying right now. We've had some high-profile purchases within the past 3-4 months, Ackman being one of them, but we also had a high-profile sale. Wedgwood Partners that owned it for a very, very long period of time decided to sell out, and I started listening to kind of the rationales that a lot of these guys were putting out for selling, and I don't necessarily disagree with some of the points that they brought up. I mean, the biggest point is always Berkshire's size is going to be an impetus to them growing over the long run. Charlie, I think, has said years ago that size is a big anchor, and it really sort of makes it more difficult to grow the business. And I think what we've seen over the past 10 years is a firm that's got a large market cap, generating a lot of cash, but having no real opportunities, to really grow the business. So it's been, even more difficult than we've seen historically. The second line, this is actually the title of a piece I wrote in 2013 when I walked away from the meeting. And my key conclusion was the company had too much cash and not enough good ideas. And I think back then they were sitting around 30, 40 billion in cash. And on a dry powder basis, that probably works out to about 15 to 20. They just reported over the weekend, 128 billion. You take out the 20 billion backstop for the insurance business and some of the mandatory sort of CapEx startup and operating cash, you're probably about 100 billion in dry powder. It's really just gotten to the point where there's just too much cash in the business. Another point that one of the sellers brought up was the performance of some of the businesses they bought over the past 10 years has been underwhelming. Precision cast parts, I agree. Has not been as good of a deal as you'd like to. I mean, I think they bought it too early, and then they've had declining earnings, write-downs, impairments in parts of the business, and I think the story going in was, there's this great bolt-on acquisition vehicle that historically was buying up companies and generating better and better margins over time, and that under Berkshire was just going to get better because they didn't have the restraints and greater access to capital. And honestly, they've not done a whole lot from an acquisition front since Berkshire folded them in. And that same sort of thing played out with the automotive group that they bought. The thought was consolidation would come. They would start consolidating up auto dealerships, and it just hasn't happened. And then Lubrizol sort of had the same thing. They found some deals to do, but I'd say probably about half of them haven't really worked out. So it's been for shareholders, it's been a bit of a disappointment in some regards. And then the other point here is Buffett's been really poor about returning capital to shareholders. I mean, he's historically had the notion of, I'm not going to pay a dividend because the retained earnings, I could probably do a better job reinvesting them than most shareholders can do. The problem is the past 10 years, that probably hasn't been the case. I think somebody getting that dividend, putting in an index fund probably would have been doing better over that 10-year time frame than they had with Berkshire. But the advantage, though, is having that much capital in their hands when deals do pop up. So it's sort of a double-edged sword. And then the other question is Berkshire shares are likely to get pummeled once Buffett leaves the scene. I'm not sure how much faith to put in that. I mean, I did look at the whole Steve Jobs situation with Apple when he passed on a few years ago, and I think there was a more unique situation because people knew that he was ill for a good 9 months to a year before the event actually happened. So it wasn't a surprise. But I think the thing is when we look at the cash balance, I've generally told people, like, look, I don't think Berkshire will ever come out and say it, but I get a sense that part of that cash balance is a break glass in case of emergency fund. That if Buffett does pass tomorrow and the stock goes down dramatically, they could quickly put money to work shoring up the stock price and keeping it from depressing too far. I think the pressure for the company is, what happens with the Class A shareholders and what do they do? The less liquid of the two shares and trades about 300, 400 shares a day, you just increase that tenfold. That's only 3,000, 4,000 shares a day, but you think in an event where Buffett were to pass, you could potentially see that. And the real issue is how much downward pressure would that put on the stock overall. And then the classic, Berkshire's underperformed the past year. They've not done well. And as I pointed out in the research piece we just did, well, they tend not to do well when the market's up double digits. I went back and looked at all the periods, the past 2 decades, and when the market's up more than 10%, Berkshire on average tends to trail the market by about 800 basis points. This past year it's been about 1,000 basis points. But I think we're also sort of later in the cycle with the market. And that's sort of what really sort of brought me to the ideas of could I come up with 5 good ideas why investors should be really looking at this firm and thinking about it for a longer term investment. And the first one was the broad diversification within the portfolio, the decentralized nature of the business. It tends to provide additional opportunities for the managers running those businesses, and also tends to minimize losses. We've definitely seen a sort of easing over time, or a folding out of bad results on individual parts of the business when it's offset against the rest of the portfolio. And I always highlight to clients, when you think about, Geico, when they went that, almost 2-year phase where they were aggressively underwriting business when everybody else had pulled back and taking on a much higher loss ratio in the process, they could afford to do that. They're just one insurance company within a larger conglomerate of insurance businesses within a larger business overall. So they could afford to post a lower combined ratio than they typically have, and grow market share in the process. I mean, it's not a process we like to see with P&C insurers overall, but I think Berkshire's unique, and those managers are positioned where they can do that from time to time. And I think the thing is too is when you look at what makes up the whole, the more interesting thing about the insurance business historically is, the fastest growing and most profitable piece of Berkshire's insurance empire is the primary group. It's not Geico, it's not the reinsurance business. It's the primary group, which is a hodgepodge of a lot of specialty insurers. Their combined ratio on average has been closer to 90%. Geico's historically has been about 95, and the reinsurance business strives to be break even and doesn't really succeed at that. But again, that's reinsurance. That's a much tougher business to generate consistent operating profitability in. But then on the other side of the coin, you've got the MSR, which is now this big hodgepodge of a lot of different businesses doing a lot of different things. And what's really more important on that side of the business is what Lubrizol, Clayton Homes, Marmon, ISCAR, and Precision Castparts are doing, because they're the biggest generators of operating profitability for that particular business. Burlington Northern, a good, stable, wide moat railroad firm. And then Berkshire Energy. And whenever I talk about Berkshire Energy, I like to point out the fact that they're probably the most uniquely advantaged utility operating in North America, because they're not public. They don't have to pay out 60 to 70% of their earnings as a dividend. And because they're part of the larger profile on the tax basis, with Berkshire, they're able to invest a significant amount of money in alternative wind power solar farms and get the tax breaks from the federal government than they would as a standalone business. So we really like that business, and whenever conversations come about, for 10, 20 years down the road and, the managers aren't able to grow the business, at a pace, and it comes time to maybe potentially break up Berkshire, what would you probably fold off first? And I'm always like, well, the railroad's easy to spin out. You'd have to think about combining some of the other businesses to spin out, but insurance stays and the energy business stays, because again, big, huge advantage of operating under that umbrella. When we talk about the business overall, from a conglomerate perspective, they've really succeeded where a lot of conglomerates failed. And I think part of that success has come from the fact that they've been completely decentralized. There's not a whole lot of overlapping business, not a whole lot of synergies to be sought after. So from that perspective, they let the managers that run the business when they buy them continue to run the business. And the reporting controls and those structures are very limited overall. For most of us that look at companies, our first impression is warning. But, for them, it's worked. And occasionally you have instances where things blow up or a manager does something bad, but that's sort of the price you pay for allowing this sort of system to exist and work. And I think the thing is when you look at sort of, these different businesses, Buffett tends to be attracted to moatier firms, or at least moatier firms at the times that he acquires them. Companies that have some sort of advantage that allows them to earn excess returns over a longer period of time. It's not to say that he doesn't go discount hunting or isn't, or is unwilling to sort of, pull up a name that, may be more of a cash generator than, it is sort of a growth story. That's sort of the thing that they went through with Duracell a few years ago, where, in a tax advantage trade, they gave up their P&G stock and took the Duracell business off of P&G's hands. The battery business may be dying, over time, but it's still a huge cash generator for them. And then, overall, I think the big advantage overall is, having this thing set up in the holding company structure where so much of the cash flows freely and is able to move around in different parts of the business when opportunities do arise. And I think one of the successes we've seen over the years has been, when Buffett finds a way to use his Buffett seal of approval, to extract high rents out of parties. And we took a look at some of the deals that they did post-financial crisis. The initial outlay on a capital perspective, and then sort of the returns they got. Return of the initial capital plus interest, dividends, warrants, any other sort of kickers that were in there. And surprisingly enough, everybody looks and says, "Oh yeah, they made a killing on Goldman." Well, they actually had a better deal with Wrigley during that time frame. I think for a while there, and I can talk about this because my wife works for Wrigley and she was there when all of this happened. They saddled Wrigley. Mars did a leverage buyout of Wrigley and saddled them with 11% debt that was funded by Berkshire. So that was the summer of 2008. And Wrigley spent the next 6-7 years working aggressively to get that debt off the books because it was killing them from a coupon perspective. But for Berkshire, they were pulling in some really, really good returns. But the real winner was the Bank of America. That was a very interesting outlay, and people were surprised when he did it. But they've made a significant amount of money off the shares there, post the conversion. And I think that's one of the unique things that we like to point out to Berkshire and like to point out to clients. Like, yeah, there's a ton of cash on the books, but look what he's able to do when we have these unique disruptions in the market. So sometimes some patience is rewarded. The other thing is, when we look at sort of the structure of the organization, BNSF, everybody thinks it's a stodgy old railroad, but this is a company that's funneled up about $32.5 billion to Berkshire just in annual cash dividend payments since it was acquired. Our expectation is, over the next 5 years, it's probably about $5 billion a year. But when you look at sort of the acquisitions they've done during the same time frame they've owned it, just that cash payment covered about 40% of the outlay that they did for things like Precision Cast Parts and Nevada Energy and Lubrizol. So that cash generation that's coming from that business is still pretty significant, and that's even with the capital-intensive nature of the business overall. The second point I sort of put down on paper was, Berkshire's still likely to generate returns in excess of their cost of capital. And when we look at moats, when we think about moatiness of businesses over a long-term time frame, that's sort of an essential thing for us, either on an ROIC or an ROE basis, that the company's earning more than the capital costs them. And Berkshire's kind of unique because, on a straight cost of capital, weighted average cost of capital basis, it's probably about 7.8%. You take all the debt there and look at it that way. This is where the conversation of float tends to come in too. People talk about float and sort of the free capital or the negative cost float. You can tweak that cost of capital a little bit with that. I'm not too positive about doing with the negative cost because that's assuming consistent operating profitability on the underwriting basis. But yeah, I still look at the fact that probably somewhere closer to 7%. If you just assume the longer tail insurance business, the reinsurance business, because that stuff they tend to hold for multi-year periods. I mean, whenever the conversation comes up about float, because people are always like, do you value the firm on a float basis? I'm like, well, no, we don't. Because we look at float as a liability, and we look at it as an essential part of the insurance business, and it's intricate in our discounted cash flow model. So, we don't try and break that out and run a valuation that way. And for your short tail businesses like your Geico or your primary group businesses, that turnover can be 6 months or a year. You're holding that money for that time frame and probably paying out 90, 95% of it. And you're earning returns on that, but you're typically in very liquid cash-like products, so you're not earning a whole lot overall. The real value of the float comes from the reinsurance businesses where you're holding over multi-year periods. The third point I sort of looked at was, the balance sheet has generally been a good positive attribute for the business. On the reinsurance side, they're able to write larger contracts, business that a lot of their competitors haven't been able to touch or look at. And it's also the notion that there's so much capital flowing through the business and so much cash that's available for the current operators, where they can tap into a lower cost cost capital when they want to do capital investments or want to do an acquisition. And when we look at sort of the cash and equivalents at Berkshire, over the last, I'd say 5+ years here, it continues to grow at a pretty meaningful pace. I mean, we're sitting at about $128 billion right now. And like I was saying, when you strip out the capital expenditure funding, operating cash, and then that backstop for the insurance business, you're looking at about $100 billion in dry powder at this point. The fourth thing that sort of came to mind as I was going through this whole process was, and it's something we said almost 5 years ago. Berkshire is at sort of that precipice of evolving from a reinvestment machine or an investment vehicle overall into a returning capital to shareholders business. It's getting harder and harder and harder for them to find the kind of deals that Warren and Charlie were doing 20, 30 years ago. It's just, there's too much capital out there chasing it. Too many private equity guys. Valuations are too high. And it's sort of gotten to that point where it needs to start returning more capital to shareholders. And I think Warren acknowledges this, but I think at the end of the day, he's hesitant to really sort of go full board into it. He's still holding out hope that he's going to find a good deal in that next downturn. He definitely doesn't want to pay a dividend. I mean, what I was saying about sort of that meeting, going in and putting together questions, I tend to sort of fall more on the utilities and railroad side of the questioning. Jonathan Brandt and I, when we were, first came onto the panels, the only instructions we got from Berkshire was, you're not allowed to ask questions about insurance because there's a sell-side insurance analyst there. So that's for them. So you guys get to ask questions about anything else in the rest of the business. And I have more insight from our organization into like the railroad utilities industry overall. And so I focused a lot of questions there, but I also was looking at capital allocation questions, succession planning, a lot of different things there. And about 3 years ago, I started down the path of trying to gear more of my questions into cornering Warren into a position where we'd all get a better sense about what capital allocation was going to look at over time. So that first year, I really pressured them a lot about dividends, and whether or not they set up a repeatable dividend or whether they would actually pay a one-time special dividend if that cash balance got too high, because Warren had made, I think, the mistake of saying, I can't sit here a few years from now with $150 billion on the book and be able to, justify it to shareholders. So he really kind of boxed himself in there, and I was like, well, we need to sort of push the issue and get him into a corner. And what I came away with that meeting was him basically emphatically saying, I will never pay a special dividend. And he made a point of coming to the brunch, up to me the next day at the brunch and saying that was the first things out of his mouth. So I want to be clear, no special dividend. So that's off the table. A dividend itself, it could still happen on his watch, but I get the sense that he wants to leave that as a tool for the next guys. Because again, if we have a lot of selling pressure out of the gate, Buffett's gone, I think the first order of business for the next managers is sort of placate the shareholders, calm the situation down. And probably the first words I want to hear out of their mouth is, we're not Warren, we're not Charlie. We shouldn't be allowed to have this much capital on the books. We're going to start returning some of it to shareholders. And that's probably setting up a small regular dividend and then increasing it over time based upon what the opportunities are for them. And I think that's Warren's sort of long-term game plan there. So when we look at capital allocation, then you've only really got 3 options. You've got acquisitions, stock investments, and then share repurchases. So the last 2 years, I've been more focused on, why aren't you doing more share repurchases? Why aren't we seeing more from that level? And I think it just makes sense. We're at this point now where there haven't really been any attractive deals. And the one deal that I think they screwed up, which was Encore, was a situation where they came in and tried to nickel and dime the sellers. It was a bankruptcy situation. They went out, they did the smart thing, went out and got all the regulators on board in Texas with what they were planning to do. So they did what nobody else that had bid before, because there was 3 other bidders before they came to the table. And all of them failed because the regulators didn't like the plan. So here it was in bankruptcy, and basically the debt holders were controlling the situation. And Berkshire comes in, gets the regulators on board, and then comes in and offers $500 million less than the last guy. And basically pissed off the debt holders. And they brought in a different consortium, and it got taken out from underneath them. And I think for them, the problem was, Buffett's always had this mantra, we don't do bidding wars, we don't do auctions. But I think if they'd walked into the table with the same price as Nextera had, they would have walked away with Encore. And I think that would have been a very attractive asset for her, because it was transmission assets in need of a lot of capital expenditures. So it would do two good things for them. It would take away capital that's sitting on their books, and they were likely to get more favorable rate cases from the regulators because they were willing to commit to a lot of capital investment. So I think from that perspective, it was a missed opportunity. But overall, it's been really difficult for them to find deals. I'm still curious to see what they were looking at the fourth quarter of last year. But I think the other thing is, in Buffett's mind, I think he's looking at it from the perspective of, this is probably my last deal. This next big deal that I do will be the one that I'll be remembered for. And I don't want to screw it up. And I think that, in some senses, it's just human nature. I think behaviorally, I think it prevents him from maybe pulling the trigger, on something that might, 10 years ago looked more attractive to him. So that really leaves stock investments and buying back stock. And on the stock investment front, we've actually seen a lot more activity. In fact, I was just rolling through the 3Q numbers last night, and it looks on a net basis, they probably spent another $10 billion on stock purchases during the third quarter. Most likely Apple and Amazon, for those that are wondering. But we'll have to see when that 13F comes out. But I think overall they will be opportunistic, and I think that they've been very disciplined about that. They've been very good about stepping in when the market kind of sells off to pick up some investment ideas for the portfolio. The problem is they haven't done the same for their own stock. And I think for a long time, share repurchases weren't even the conversation. And then in 2010, I think they rolled out the first, it's 2012. They rolled out the first, notion that they would buy back shares at less than 1.1 times book. And then within 2 years, they had to change that to 1.2 because they actually had a large seller of Class A shares that was unwilling to take the 1.1 and wanted the 1.2. But what happened because of that is because they drew the line in the sand, is for the next 5-6 years, it was a floor. And the stock rarely traded below that floor. In fact, I used to tell clients, if it gets below 1.3, you should be buying. Because it would barely get to 1.25 times book. But at the same time, it really prevented them from buying shares. And I think last year they realized that, because of a lot of the questioning we were putting on the table and a lot of pressure for them to do something with the capital, I think they realized they had to sort of change that up. And so it's more opportunistic now. When we feel that it's trading a deep enough discount to our sense of intrinsic value, we'll go out and buy back stock. And the funny thing is that first 2 months after they announced that, he was out buying shares at 1.4 times book value. And I'm like scratching my head and going, is my valuation wrong? If I missed something here? Is the stock really worth significantly more than I think it is? Because 1.4 to 1.5 has been sort of the normal range of the markets attached to this thing over the last 10, 15 years. So it's not like he's buying at a significant discount to where the market's had it. But the last 3 quarters, it's been actually closer to 1.3 times book value, which was sort of my initial impression. That was, if he was going to be buying, he was probably be buying closer to 1.3. The problem has been kind of underwhelming. I think they've bought maybe $2 billion this year, over 3 quarters. And by our math, they could easily do $1.5 to $2.5 billion a quarter and not break a sweat. And just remember, we've got the railroad funneling up $5 billion in cash. So something has to give on this front at some point. And I think that, as that cash balance gets closer and closer to $150 billion, he's going to have to do something more dramatic. And I think he sort of set the stage for that this year with the annual report, trying to sort of tone down the focus on book value per share. Because what happens when you do a large share repurchase, it kind of screws everything up, from looking at the firm on that perspective. So that tells me that he's sort of prepping the potential for them to do a large buyback, somewhere over the next 2-3 years if they need to. Yeah, like I was saying, there's been repurchases of late. Our run rate actually on an annualized basis for our forecast is about 10 to 15 billion. And that's because midway through the cycle, we're including a 25 billion share repurchase. Because, we sort of did the math, 20 billion in free cash flow annually, rotated up. They're at 150 billion, 2021. So they'd have to do something. But for us, that's more, just honesty. It takes cash off the balance sheet, and only has a marginal sort of improvement on the valuation. I mean, the returns on capital and the returns on book value per share from that point onward look a little bit better because you've sort of decreased the book value per share overall. But from a capital allocation perspective, this is what we've really seen, and what really sort of stood out to me last night as I was updating the third quarter numbers is there's been a lot more stock purchase activity the past 2 years than we've seen in other periods. So it is really kind of fascinating to sort of look at where the cash outlays are going. But again, I still think longer term we're going to see more acquisitions overall. Or, I mean, not acquisitions, share repurchases. And then the fifth point, and I got lucky timing-wise, was the stocks are really kind of cheap. And when I rolled out the report, it was actually trading at about a 25% discount to our fair value. Right now it's about 15. So we've had a nice little run over the last month and a half or so. But it's still reasonable. And the thing is with Berkshire is it tends to be more of a defensive stock anyways. It tends to behave more like a defensive name than it does a growth name. So when the market does go down, it tends to outperform the market on a time basis overall. And and when I looked out going forward, I mean, I cover the U.S.-based asset managers, and I've been looking for a correction for 5 years now. But we know it's eventually coming. We're getting closer and closer and closer to where it's going to come. In fact, I thought fourth quarter last year was the start of a sustained bull or bear market, for a period of time, but it just didn't pan out. But I think for the U.S., economic growth is slowing. Business spending is down. It's sort of really setting up the stage for a slowdown in the U.S. economy, if not a recession. And usually what comes with that is a sell-off in the market. So we're getting closer to that scenario. And that's really sort of the time to really sort of be looking at and buying Berkshire's ahead of that, because it's going to do better than a lot of its peers and a lot of its financial services names, because Berkshire it's not a bank, so it's not interest rate sensitive. I mean, most of our bank coverage right now is taking it on the nose because the Fed keeps cutting rates. So that hurts them from a net interest income. But it's still relatively attractive right now at about a 15% discount. And we look at where sort of the stock's traded historically. I mean, our current fair value estimate is equal to about 1.56 times last quarter's book value per share on our estimate basis. But we're expecting to still grow about a high single-digit rate this year and next. So that puts it about 1.5 times the end-of-year book value, and then 1.37 times next year. So you kind of average that out, and it gets back to sort of that market price. I mean, it's not intentional. That's really sort of the way it ends up working out. Because the way in which we value Berkshire is we actually tear the entire business apart. So we're valuing the railroad, with our railroad analysts. We're valuing the energy business with our energy guys. I'm working with the consumer cyclical analysts when I'm looking at the MSR business and some of the industrial guys. And then the insurance business, we run through the regular model, along with the investment portfolio. So it is really a true sum of the parts kind of DCF. But we also spend time triangulating our estimates and our results against the rest of our coverage to make sure that, where Berkshire deserves a premium, like with the energy business, our valuation is coming to a premium relative to the rest of the group on our forecasts there. And where it probably deserves a little bit of a discount, and I put the railroad there because it's not quite as profitable as its closest peer, which is Union Pacific, it sort of makes sense there. But overall, when we roll that all up, get the fair value, it ends up coming, pretty close. And I look at all the work I've done and been like, did I really need to do all that work? Because, I could just plug that number in there. But I think it's intellectually honest to really sort of do it and deep down, dig into it. But, that ended up being sort of the 5 reasons and really sort of put the piece out that way. I mean, it's, Berkshire is not a growth story. Berkshire is not a glamorous name. But Berkshire is uniquely positioned and has a ton of capital on hands. And I think that that's something investors really want to be focused on as we go through the next, sort of phase of the market. And that's it. So I guess we could take questions if we have time. If you want to.
Provocative question. I've been to the shareholder meetings for 25 years now, and the last 3 years didn't feel much. What do you think about his intellectual capacity? Is it, he's still brilliant, better than most of us, but is it still fascinating?
I think there's a big difference between what you see on stage in real life. I think the biggest challenge for me as an analyst asking questions is I know Warren will evade my question if he can. And that's why I always tell because I'll get queries from clients. We'll get questions, phoned in during the course of the year, like, hey, I thought maybe you should really look at this or really look at that. And that does help us in some regard, because if I see the same question coming up again and again, it sort of helps me sort of, line up questions. But it's the hardest thing I do as an analyst every year, because I have to sit down and write questions and cut off avenues of escape for Warren, because I want to sort of direct him to where I think the answer should go. I may not get the answer I want, but it's still, I want you to answer the question this way. And there was trial and error. I learned it over time, with him, because there was one question I asked questions about American Express, and he told me a story about traveler's checks and the salad oil crisis and a lot of those things. And I think for him, that's easier to sort of spout off on. And I think when we ask him a difficult enough question about the operating businesses, he will deflect and have Matt Rose or Greg or Ajit step up and actually answer that question on that level. I don't think it's a lack of intellectual capacity. I think that he understands the import or the value that his words has sometimes, and now it's even more so because they're live casting the meeting. It's why I tell clients when they say, well, why don't you ask about Visa? And I'm like, because if I asked a straight question about a stock, I will not get an answer. Or if I ask him directly about Wells Fargo, he's not going to talk the company up, he's not going to talk the company down, because he doesn't want to be in a position where he's affecting the trading of a particular security. So to your point, I think it's been tougher since they started live casting the meetings, for him to be as straightforward and transparent as he might have been in the past. Off book, it's a different story. I've had good conversations with him at the brunch. I've had really, really in-depth conversations with Ajit and Greg Abel and a lot of the other guys running the business. So it's slightly different. But again, like I said, we were brought on board to do a job, and I kind of looked at it the first year. I'm like, God, I'm just the entertainment. I'm part of the show here. And they want me to ask questions so they can talk about the business. And, I walked away from that like, no, I'm an analyst. So I came in the next year, and if I can get at least 1 or 2 questions where I'm learning something that's helping me understand or get a better sense of the business, I feel better. And this year too, it wasn't so much on the business. It was, getting Warren to admit that shift to a returning capital to shareholder business, that quicker shift might happen on his watch. So he's really sort of cognizant of where he is. And there's been a couple of years too. It was always up in the air. We didn't for the longest time, we didn't have a straight dialogue with them where they'd call us up and say, will you be on the panel next year? It was always wait for the annual report to come out. Is your name in it? And you're on the panel. And that was fine. And Jonathan and I both were, he's done it 7 years now, and I've done it 6. And this past year, the annual report came out, and before I start working on their earnings, I always type in my name. And I did that, and it wasn't there. And I typed in Jonathan's name, and it wasn't there. And I typed in Becky Quick because I knew that would probably be there, and it was. And what Berkshire had done is in the area where they talked about we'll have 3 journalists asking questions, and they give the names, and we'll have a panel of analysts. And I was like, well, what does that mean? So I actually pinged Debbie Bosonic, and I said, I don't want to assume anything, but are we on the panel this year? And, just because our names weren't in there. And she's like, oh, no. We screwed up. You guys should have been in there. In fact, Warren wants you and Jonathan back every year, because you asked, good, tough questions. And I was like, phew, I didn't screw up. I didn't piss these guys off. And wow, I'm back on the panel every year now. So it's kind of nice from that perspective. But again, I think you're right. I think we look over the past 3 years, it's been a little bit different, and I don't think we've had the same level of transparency as we may have had in the past when it was more of a closed event. Yeah.
You said that you would buy back shares if it's discounted enough. But what is discounted enough for him? He knows Berkshire Hathaway perfectly. So is it 20%?
I think it's apparently around 1.3 times book value. I mean, if you look at the track record of the last year, that seems to be where he's more comfortable buying back. I think if it was less, we'd probably see more. But I think at the end of the day, Warren hates to part with money. I think he hates the idea of taking capital that he could use to buy businesses or to buy stocks and give it away. Because I think at the end of the day, he still looks at it from that perspective. I mean, for the business, it's actually a good decision. From his estate, perspective, it's actually a good decision because, one of the things we cornered him on was, when he looks to buy back stock, he's looking primarily at Class A shares. And that's good knowledge. That's important for us to have. And for him, it's about eliminating as much of the super voting rights as possible because he's already doing that every year when he gifts shares to the 5 charities he gives to. Basically converts all those over to Class B and works it off. So when you look at sort of the trend line of the voting control of Berkshire's surviving shares with the trust, there's still probably about a 10, 12-year time frame after he passes where the trust will still have significant weight, on the business matters. But, share repurchases, buying back a bunch of Class A shares, that would actually help improve that situation. So, we'll have to see. And that's sort of a question I'm trying to think about formulating for this year. It's trying to sort of get into his mindset and how he thinks about these things.
Is there a good underwriter underneath the Jeep in the market if the rumors turn out to be true or that he has problems?
He didn't look too good this year.
I've heard it
Yeah.
from multiple people.
Yeah, and I wouldn't be surprised. The woman who, I can't remember her name off the top of my head, but the one who was his lieutenant at Berkshire Reinsurance, who he brought over to take over control of Gen Re. That was probably one of the most interesting conversations I've had with Ajit was that year that he took over control of Gen Re. He spent an hour with Jonathan and I, basically talking about all the positives, but also all the negatives of Gen Re and the things he wanted to do to sort of improve it and work on it and fix it. And he talked high praise of this woman he was bringing over, and she's done a pretty good job. I mean, when I look at sort of the track record since she's come on board, you're seeing more stable earned premium growth. You're seeing better profitability overall. So she knows the business pretty well. Where Ajit comes in is it's the same sort of thing with Buffett. The value of Buffett is sort of that Buffett seal of approval. It's the ability to extract 9% preferred stock rent or 11% debt, from people that need capital or need that Buffett seal approval. Ajit's strength is finding unique, large risks that they can underwrite and potentially make a decent amount of money on. The problem is, there's a lack of transparency within Berkshire's insurance reporting that would allow us to see how some of these deals have panned out over time. The only way we look at it is from the perspective of if I'm underwriting reinsurance and I'm break even and I have that money for a longer period of time and I'm investing a lot more of it in stocks, then I'm probably doing okay. So from that perspective, it hasn't been bad. But I'm really curious to look at the return profile for the AIG business because AIG scares me. And, their underwriting has been really, really poor historically. And basically Berkshire said, well, we'll take on that risk, and take the $10 billion up front. And I don't know if that's really going to be a high return vehicle for them longer term. So, they, like anybody who's human, they're the strive to find deals sometimes, you step into something that, may not be as lucrative as you thought it was going to be. But again, I do take comfort in knowing that there's a good second in command there. In fact, it's interesting to see kind of the changing of the guard and the embracing of different things. I mean, I think Geico's going to run better now that Tony Nicely's not running it. Tony Nicely's a great guy. I think he did a great job growing the business, but I think that I always felt there was a hesitance on his part to do certain things like, adopt telematics. I remember having a conversation with him about it like 5 years ago. Why haven't you adopted telematics? Progressive's doing it. A lot of the other players are doing it. It makes sense. It's you get a better sense of what a driver's track record is, and you can do better underwriting as a result. And Geico is just sort of blunt force. We're just going to go out and underwrite a lot of business, drive our expense ratios down so we can carry a larger loss ratio. And it's worked. They very rarely, look like they were going to, underperform on an underwriting perspective. But, when I talked to Tony about it, I was like, why aren't you doing it? His answer was like, well, automatic braking is mandatory in new vehicles in 2020, so it's not a problem. And I was kind of bewildered and was like, well, so 7 to 10 years from then, it'll have rolled through the entire fleet. So it's not a problem for you for 15 years? I'm like, that just seems an awful lot of time to give your competitors, the ability to basically take some of the best drivers. Now the word we've been hearing lately has been Geico's actually testing an app, to put on smartphones. So, in some ways, this hesitance actually may have worked out for them from a cost perspective. Because Progressive was first and the pioneer, but it cost them a lot more on the expense side to sort of roll up, run that business and sort of get them to where they are. So if Geico can step in now and just, put an app on people's smartphones, it's a less costly way to get it. So, that may have panned out that way, but I mean, I think that might have been the better answer than, standard braking is going to be mandatory.
You just touched on Buffett's serial approval, and you had a great slide on 2003 deals.
Yeah.
If this next crisis happens post-Buffett, will Berkshire still have access to?
Yeah, I think they're still going to be able to do some decent deals without Buffett. But this was a question 2 years ago that came up at the meeting, and I didn't like sort of the way they answered the first time. So when I got my first question, I was like, I want to follow up on that because I don't believe you. Because Buffett basically said, oh, the guys behind me, they're going to have the same opportunities. They're going to be able to earn the same kind of returns. Berkshire will be seen as sort of a beacon of cash and influence that, will be able to sort of step in. And I was like, I don't buy that. I think that you have something that they have capital, but they don't have your sort of cachet. So they're probably going to earn a percentage or 2 points below. So instead of getting a 9% preferred, it's probably a 7. Instead of getting 10 or 11% debt, it's probably 8 or 9. So they'll still get attractive returns. It's just not as lucrative as it was during the Buffett years. And Buffett disagreed with me, and then he asked Charlie what he thought, and Charlie said, well, I agree with him. So I just turned to Jonathan at that point in the meeting and says, well, that's my first question, and I'm done for the day because, I can't beat that. So I think from that perspective overall, yeah, I think there's a realization that, the next guys are going to struggle. And again, it's the nature of the beast too right now. And the next guys I think are going to be more focused on how do we assess how much capital we should have on the books and how much can we, reasonably return to shareholders, in an expeditious way. And on a consistent basis. So I think that's really going to be the challenge for the next guys. But I still think they'll be able to do deals, and I still think they'll be looked to, as a source of funding. Sort of like this deal with the Anadarko recently. But overall, I just don't think it's going to be as lucrative. Unless Greg and Todd and Ted sort of have a huge track record of doing great things with the money, then they could charge a premium to what they would normally get. Okay, well, thank you. Oh.
question.
Okay.
I have great trouble taking the 10K apart because numbers don't add up. You know, insurance business where it's the overhead.
I have as much trouble as you do. I mean, I think the biggest problem I have is the numbers on the energy business don't line up with the numbers in Berkshire's 10K, and there's a lot of adjustments I have to make. And it's not just they're only getting 90.9% of the business because that's how much they own of it. It's just some goofy stuff that goes on within there. Yeah. So my biggest challenge every year is, especially when I roll the model, is trying to line all that stuff up. And that's like, because of what we do, because we strip everything apart, and value the things separately. I'm always talking to the other analysts and saying we need to err on the side of caution with everything. If we think it's likely to be 3% volume declines on the coal business, maybe it's 4. If we're looking at the insurance business, let's put in a super cat loss midway through the cycle. Let's make sure that we're being conservative, because when we piece this all back together again, just the potential for error has increased, meaningfully. So let's just make sure that we are doing all the right things. But I agree with you. I mean, that is a hassle. And I usually work primarily off the segment reporting numbers. But then I'm also trying to sort of line things up. And our energy analyst is always like, you're silly. Don't even do that. You're like, let's just run it through the model this way. He's like, don't even think about revenues in this business. Think about EBITDA. That's really sort of the driver. The cash flows that come out, overall is far more important. So yeah, no, I mean, you're not alone. And I've been doing this for 10 plus years, and it's probably the biggest challenge, with that thing, which is, why it's harder. It takes me longer to roll that model every year than it does any of the other models, because I have to sort of, make sure all that stuff lines up. Okay, yeah.
One final question before we go to the... Munger's always been very fond of LiLu in his investments in his Chinese fund. There's been a lot of talk in past years that LiLu might be brought on board when Charlie and or Warren will step out of the company as one of the portfolio managers, which would also increase Buffett's international footprint, no doubt. So, to what extent is that a reasonable expectation, or is that just maybe wishful thinking by people who see LiLu's return?
I'm not sure how reasonable the expectation is. I think it would be additive, but I'm not sure. Attaching yourself to this ship where it will be is going to be a little bit different. I mean, he'll bring a different profile, obviously, on an international basis, and I think Ted and Todd will benefit from the interaction as well. But when I look at Berkshire in the long run, I mean, my sense is still is Greg Abel's probably the guy that's going to take over as CEO. I mean, Ajit, aside from the health issues, has historically said he does not want to be CEO. He does not want to be in the spotlight. He doesn't want to take Warren's place, and it's really sort of a no-win situation for the next CEO. But I think the situation is they're going to have a team of managers running this business, because there's a lot of different things they have to do. And shareholders have been relatively complacent for many, many years and allowed Warren and Charlie to do what they've done. But we're going to get to a different phase in the business, and I think that anything they can do to sort of help, anything to improve the investment profile of the business, I think will work overall. I mean, when we look at it too, I think Warren had thought he found a partner in 3G. But I think that relationship is really soured at this point. But again, that's Buffett's own fault. He thought he could be the bank, get a nice return, let 3G run the business. And then that was one of those areas where not really being a traditional manager and decentralizing your organization, you weren't focused as much on what 3G was doing at Kraft. Or Kraft Heinz, and when I look back, because I covered consumer staples for a decade, so when Heinz was looking to buy Kraft Heinz, I was like, I really don't understand this. You must be seeing something I don't, and there must be some synergy about having middle of the store businesses, because I covered this business, and the first big mistake they made was when they sold the DiGiorno pizza to Nestle. They sold a high growth business. And then after the Cadbury deal, they took all the good pieces and put it in Mondelez. and then pushed it out the door, and it left a lot of commodity businesses that, you know, were branded, but it's brands that I was harassing Kraft for years on. You know, where I just couldn't understand why they were spending so much money on marketing and R&D. Now, 3G's fault was cutting all that to the bone, you know, and basically broke, you know, the packaged food business, you know, and it's going to take a while for that to be fixed, you know. And I think for Warren, I would gesture to say that probably over the next 5 to 10 years, he's probably going to be a net seller of that stock as he, you know, as opposed to buying more, you know, because his comment was, you know, we love Kraft Heinz, you know, in years past, we love Kraft Heinz, and if 3G is selling, we're buying. What 3G was selling this year, and Buffett wasn't buying anything. So, you know, I look at that relationship probably not continuing on the same basis we move forward. Thank you.
Thank you very much.
Thank you.
Okay.